So, will the stock market eventually crash? Stay tuned and don't miss the charts at the end of this presentation where I try to answer this question. This is the 13th of August 2021, lucky Friday 13th. I've seen a lot of questions from my students and others that I thought I would try to answer. First question, will the stock market eventually crash? Will the Fed crash the stock market? Will the stock market crash because of inflation? Will the stock market crash affect housing prices? Will the stock market crash, ever crash and not recover? That's an important one. Will the stock market crash like 2008? How does the stock market crash affect me? And finally, most importantly, will the stock market crash before Christmas? Let's go into some of these questions. Will the Fed crash the market? Well, one thing that's happened, this chart I show right here is the effective interest rate in the U.S. going down and down and down. And the result of that is that companies have had such low-cost funding that they've expanded into projects that you can see the red line, the asset turnover, has gone down and down and down. What does it mean? The asset turnover is on the right-hand scale. Previously, it was 1 for 1. For every 100 that they invested in assets, they generated 100 in revenue. Now, for every 100 they invested in assets, they generate about 70 in revenue. So a much lower level of asset turnover. The next question, will the stock market crash because of inflation? Well, I've done a lot of looking at the history of inflation, and what you can see in this diagram here, and the most important thing really, I'm just going to grab my pen, is kind of this mark right here, and you can see that the inflation rate has started to turn. The question is it going up? Is it going flat? Is it going down? Well, my answer is I think it's going to be going up. And in fact, one of my biggest fears is war. And really the key, as you can see, war is what drives inflation because there's so much demand. And so that's my fear, is that we are going to see inflation rising. Now, is it the stock market going to crash because of the inflation? Unlikely. I think inflation is more impactful on the bond market. Also remember that stocks are ultimately companies run by CEOs and management teams that are trying to maintain their profit margins in the face of inflation. They have a lot of opportunities to make changes to try to adjust for that. So I think equity tends to be a good performer in an inflationary environment. Let's continue on. And let's look at one other thing about inflation. I did this study where I looked at the countries, the region that the country's in, and then I looked at CPI increasing, in other words, consumer price index, inflation, increasing in the past 3 months. What happens in the next 12 months? And I looked at many different cycles that I could find. And generally what you can find is that there's a pretty high probability, let's say over 65% chance, that the market could do well in 12-month period, but then eventually take a hit. So the answer to this is that I would say inflation's not my biggest worry for the equity market. Of course, interest rates are, and interest rates being super low, that's a problem. And inflation, if inflation pulls up interest rates, then you've got a situation where the value of stocks starts to fall. The problem that we face in the U.S. is that that would cause the budget deficit of the U.S. government to grow massively. In other words, the expenses for paying interest by the government, by the federal government of the U.S., is going to explode. And if that happens, then it's a big, big trouble. So I suspect that they're not going to let interest rates rise if they can stop it. We can already see the Fed controls the yield curve all the way across to 10-year yields. Next question, will the stock market crash affect housing prices? Well, I decided to look at a chart that I created here. I wanted to look at the blue line, which is consumer price index, and see that it steadily rises. Now I rebased producer price index, housing price index, and consumer price index back to 100 in 2000. And then I tried to see what happened. The big difference here you can see is that the housing price bubble that happened before the 2007-2008 crash had gotten massively higher. Prices of housing had risen much higher than overall prices, and you can see that. And then soon after that, it crashed, and it went down until 2012. It went back to hitting, in fact, that period right here, you can see at 2012, at that point, it came back to CPI. So where are we now? Well, we're even wider difference between housing prices and also consumer price index. So the question is, will a market crash affect housing prices? Absolutely. Or it could be that a housing price crash affects the stock market. Either of those, it's hard to say which one is going to cause the other, but I think that we are very much closer to that than I've seen in the past. Okay, will the stock market ever crash and not recover? Well, the answer to this is very rarely does that happen, and it just takes a long, long time to recover. Well, let's look at that in a little bit more detail. I did a quick study. I used data from Robert Shiller's website, and I basically went back to market peaks. And market peaks going back from 1929 until all the way until the most recent peaks. Actually, 1902 was the earliest market peak of this of the last century. And what I try to do is just go 48 months ahead, 48 months ahead, and say what happened to the market. Now, the blue line, the one that I think is the most significant, is the Great Depression. And the Great Depression brought the stock market down. It rebased from 100 down to 20. So in other words, that was an 80% fall in the market. That is the worst we've ever seen. We've never had anything like that in the past. Now here you can see 2000 was the second worst, 2007 was the third worst. So it took some time to recover. And then if we look at the crash flash, which was 1987, when the market kind of really got hit in one day and then slowly recovered, it had passed, you can see that purple dotted line. In fact, it had hit 100 within about 24 months. It had been back to where it had started. So some of these, that's the same thing you can see with the 1902 crash that's gotten back, as well as 1968. So the point is that the market will come back over time, but it will just take time. Now, we have seen huge crashes in markets, like we saw the Great Depression. We did see a huge crash in Thailand and Indonesia, these countries, as well as we saw it in Japan. And what you can see is that for almost all of those countries, it took about 25 to 30 years before the market got back up to its prior peak. In fact, from the 1929 peak, it took until about 1955 or so that the U.S. market got back up to the prior 1929 peak. So if it's a massive fall in the stock market, it takes a long time, decades, to get back. So the next question, will the stock market crash like 2008? Well, let's look at this chart. What I try to do is start with a number of days. So basically, what I was trying to understand was the level of the run-up into that crash. And what we can see is the red line is the run-up into 1987. It was very short. It was basically a peak at 451. And we can see it's almost the same here for 2000. In 2007, you saw a massive run-up, and that's a lot like what we have right now. And then you see a pretty significant and fast crash. So how does the stock market crash affect me? Well, if you're invested in the stock market, it could wipe out 20, 30, 40, 50, 60% of your wealth. Of course, you can wait and see what happens and let it grow back over time. It's very hard to even fathom the stock market crashing, because every time it's crashed in the last decade, people just piled back in and started to push that market back up again. But when the market eventually crashes, which I believe it will affect all of us, and it will affect markets around the world. All right, last one. Will the stock market crash before Christmas? Well, I don't know. No idea. But at the end of this presentation, I'm going to show you some charts that may help you make that conclusion. So let's continue on. Will the stock market eventually crash? I'm going to talk about two things here. The simplest way to start investing, and also is now the right time to invest? So let's look at the first part. This comes from my course, How to Start Building Your Wealth Investing in the Stock Market, where I encourage beginning investors to get started in a simple and safe way. Now, the simplest way to start is to think very, very long term. If you're 20 and you want to retire at 60, you got 40 years of investing ahead. Think very long term. The simplest way to start is with an instrument that owns every stock in the world. There are various global passive funds and ETFs that are a good place to start. The simplest way to start is to open an account with a minimum amount required. I always say, find the broker, fund management company that you can find that global passive index. Open an account with the minimum amount so that you can get started without worrying about making mistakes. Some of them are Vanguard, Fidelity, Interactive Brokers, Saxo, and TD Ameritrade, which is now together with Schwab. There's many different brokers in every different country, but those are some brokers and fund management companies. The simplest way to start is to contribute the same amount each month. That's called dollar cost averaging, because you contribute the same dollar amount each month. When the market falls, you will buy more shares at lower prices, and when it rises, you'll buy shares at higher prices. Now, of course, if the average person could time the market, I would tell them to wait until the market is at its bottom and then load up on stocks. But this foreknowledge rarely exists. But I'm going to give you some charts at the end of this that may help you with that. Now, the simplest way to start is to avoid making lump sum investments in the beginning. Now, it's important. It's important to mention about lump sums. Again, if you have $100,000 and you know it's the bottom of the market, nothing's going to beat putting all that money in at the bottom and letting it fly. But the problem is we don't always know that it's the bottom of the market. And so we end up putting that money in at wrong times. So when you think about a lump sum, you can put it in over time. The benefit of dollar cost averaging is that it really doesn't matter in the long run if you put $1,000 in the market at the market peak, because eventually you'll be putting the same amount in the market when it's at its bottom. Things will balance themselves out, and again, go back to thinking long term. But I had a problem. Eventually students would get a lump sum of money, as I say, lucky them, and ask me whether they should put all that into the market now. I thought about it, and the next section is my best solution for them. So, is now the right time to invest? Let's talk about market timing. After 30 years in the world of finance, I've witnessed, I've seen that timing the market is super, super hard. It's also hard to differentiate between those who beat the market through skill versus luck. Suppose you did identify the bottom of the market. You're going to have two problems. First, no guts. Even if you did identify the absolute bottom of the market, behavioral finance tells us that you would not have the guts to buy. Remember, that's all the news is bad. It's all bad. The next is you got guts, but no money. Finally, it's at the bottom of the market when everything is awful. You'll be worrying about losing your job, and you'll probably have less money and more fear. So that's the problem if you think you're going to time the market. If it's the bottom of the market, it's usually an awful time. But I know, okay, I know. You must try to time the market. That's what you want to do. But still, it's cool, it's fun, it's challenging, it's interesting. Let's look into that. Since I know that some of my students are faced with what to do with a lump sum, I developed this tool, and I'm going to show you what I've developed. It's very simple, easy to understand. The question is, rather than make any prediction, so I'm not trying to predict the future here, I'm just trying to understand the present. And rather than, predict that future, I'm just trying to understand where we are now. But that's already hard. So I decided to just focus on the times when the market was extremely high or extremely low. You'll notice I don't have any yellow in here. No yellow light, just red light, green light. Now, I did this by applying our FVMR methodology that we use in our company. Fundamentals, the level of profitability; valuation, how the market is priced; momentum, the price and earnings trend; and risk, the level of risk. I've taken this model and I've adapted it for different markets, as I often do, to try to just put together the methodology that will help me understand the situation. So I'm going to show you a series of charts, and they're going to all be rebased to 100. And here's the first one. This is global. This is the World Equity Index. And you can see all the way at the left, in 1990, I rebased it to 100, and it grew all the way up to 1,400 now. And what you can see, when the green is showing, it means that the market is attractive. When the red is showing, it means the market is expensive. So the red lights are on the World Equity Index. This is not a recommendation. This is not a forecast. I'm not saying what to do. I'm just saying, where are we now? Now let's look at the U.S. The U.S. is damn high, but the red light's not yet flashing. Momentum's still strong, earnings are strong. A lot of things have been going in the U.S. favor, but I would say we probably are going to start to see some red lights flashing. All right, let's look at developed markets excluding the US, and they just started flashing a red light. They just started flashing a red light. Finally, emerging markets, and next we'll look at Asia, but emerging markets have been flashing red and they're starting to buckle. You can see a little downturn in this area right there. There's a little downturn that's starting to happen. And finally, Asia. Asia, excluding Japan, is flashing red also. So what does it all mean? Well, truthfully, no one knows. Markets could race higher or could crash. I mean, there's a lot of people who have been calling the demise of the U.S. market and have been losing a lot of money. Even my mother is invested in the U.S. market. And every time I look at the amount that we've got in the U.S. market, I'm thinking, oh, what if this crashes? But it keeps rising. So, but at least this helps us to frame our thinking. Luckily, in my mother's case, she owns a lot of bonds also. So, but what I want to do is help you frame your thinking. So, what you should take away from this presentation. Number one, for my students who are dollar cost averagers, don't change a thing. Just keep going because it doesn't matter over the long term. Keep contributing a steady amount. And for my students who have a lump sum or want to time the market, since the markets are generally flashing red, you may want to wait a bit to make that lump sum investment. I hope that helps, and I'll see you in the next video.